Hey, this is Sasha, and thanks for joining me here for another training video. And as my promise to you, I'm looking to make more option trading and option training videos. So let's take a look here in this week's video. What I want to do is share with you how to hedge for a stock market crash in 2018. Now, of course, you could modify some of these variables. I'm not saying there's going to be a stock market crash, but those of you that are looking at things that may be a little bit overvalued, things may be stretched a little too high. So how do you invest a little amount of capital, but still potentially profit from a downside move without overexposing yourself? So that's what I want to share with you today, and that's what we're going to cover. And today we're going to talk about a little bit about the butterfly spread. Now, if you haven't joined me in the past, be sure to get on the newsletter list, which is at the end of this video or under the description. And also, don't forget to check out some of the option training courses that we have to get you started. Okay, so let's dig deeper into our butterfly spread here, and that's really what I want to share with you today. So, looking at our trade grid here. Here's the Thinkorswim platform. And again, we'll pull out, let's just say we'll do a butterfly spread strategy here on the SPX. Now, just to give you some context of where the market is, let me pull up some charts here and you can get an idea to see how far extended we are on the marketplace. So this is TC2000. As we pull it up, we'll go ahead and you'll see right there on the daily, we're at 2850. Okay. And if you look at the weekly, 2850, and you could see here's a little level at 2700, 2500, 2300. And if you look at the monthly, how far stretched you are. So the question is how much of a hedge and how much protection do you want, or how much of a move do you think we're going to pull back if you are bearish or if you're looking to protect yourself? So let's take a look at setting up a spread on the SPX. I'm going to share with you the SPX. You can, of course, set this up on the SPY, but the SPX is a little bigger. And what I'm going to do here is go into the trade grid right here. We'll go in and populate the SPX. And it comes down to how much time you want. So in this example, I'm going to go ahead and let's just say go about I could do 48 days or I could do 83-day option contracts. And what I'm going to do is let's start out with, let's just do the 48 days for now. And you'll see how this applies later to the further out ones as well. So if I go out at the 48 days and I'll go ahead and let's just say I'll right click here. I'm going to go and buy and we'll do a butterfly. Okay. We'll analyze the trade and you can see how this is set up. It's kind of a little funky. Let me make some adjustments for it so you could see what's going on here. And what we're doing here with a butterfly spread is we're selling, okay, two at the money or two contracts right there for the put side. You could do it on the call side if you want, but we're selling two at the put side and we're buying our wings for protection. Okay, so that's really the basic strategy in this butterfly spread. So I'll go ahead and spread these out on the wings. And you can see that the wings here don't have to be perfect, right? So I have a wing here that's, let's make this 2790, okay? And then the upside will do 40 points, and then the downside will also do 40 points protection. So you can see now I have this butterfly spread and it looks like a weird kind of tent here, kind of a triangle tent. And the way that this works, one of the interesting things with butterflies is because you're selling such sweet at the money or near or close to the money strike prices that with time, as you move the time forward, you can see that we get outside of our range right here for profitability, right? So that's one of the great things about this move. So as time moves forward, in fact, let me make this a little bit larger so you could see. Okay, as time moves forward, it continues to get closer and closer to this tent. Now, the most that you would make is at that peak, $3,500 on an investment of 410. Right? So you're making, let's say, 8 times on your money. So that's quite a lot. So you're not risking too much to be able to profit. And you can see, as with time, if this doesn't even work out in your favor, if the market stands still, you're still up about $154 on March 5th. Now, if it moved higher, okay, if the market moved to, let's say, 2,900, you're down about $280 for that hedge or for that insurance or for that strategy. It could continue moving higher, and then you're out $400 here. Of course, prices are shifting. Let me lock them in place for now. Okay, but with time, what happens is this gets closer and closer to expiration. You can see how this curve, boom, just explodes. So as long as, you give it about 10 days and then the market falls down, well, you make, let's say, let's not be in Disney World or be unrealistic. You're not gonna hit it perfect at the peak and make your 3,500. Let's just be real about it. And let's say within a week or two, it starts to sell off. Well, you make about $500 on about $390, $400 worth of risk. So that's a pretty good risk to reward potential. I mean, you're making basically doubling your money up based on the risk that you're putting on. Okay, so now let's say you expect a larger move than just a 50-point move. You can see right here, this is only about a 50-point move down, right? 2,800 right there. Now let's say I move this and I'll move these middle ones to, let's say I expect a bigger move. Let's say I go to, let's say we'll go 2,750. Okay, so we'll move it an extra 100 points or so. 2,650, and here we'll do 20, let's go 50, 60, 70, 2,780. Let's see, how many strike prices are we away here? Let's do a 50 point. So we'll go 2,700, and this will be 2,800 for protection. So now we're risking still $400, but our potential to make $4,400, okay? So you can see now we're widened it a little bit longer, but your potential to make more money increases. So you make a little bit more, okay, from this strategy than from the last one, because you're going a little bit wider out. So the risk of it basically working out in your favor is less. The chance of it working out in your favor is less, so you make a little bit more. Now what you could do right here is, again, and you look at it, is it moves right there, you're already making $800, whereas the last one's like $500. So this one you're already making $800, and that's at February 27th. Today, if it moved down, you make about 388. But you can see how much wider this curve gets, right? So you actually can be profitable if it goes past your point. Even at 2,600, you're still making money. And even if on the outside over here, you're still making money. So don't think of just the expiration curve. Look at the white line, which is your today line. And you can see how it works and it operates right there. In a couple of weeks' time, you could actually, if you had a 100-point move down, you could make about $1,500. Even if it blew past it, you could make $700. Now, here's the great thing about these butterflies is what I could do is hedge or shift one leg. I call it the skewed butterfly. You could say a warped butterfly, a broken wing butterfly. So I could go ahead and say, okay, well, I'll go ahead and do 2,790 instead. Well, now I'm only risking $155 instead of the $400 to still potentially make some. Now, remember, nobody's going to give you anything in the market, so that means this leg actually went down. So you're risking more on capital here. That's 1,160, okay, because before it would be only 385, right? And over here, 395. But now if I move this up, I'm risking only 155 if the stock stands still, but about $1,000 on this side. But you still, with time, you can see, continues to grow and grow and grow with the time decay. It allows you to protect yourself against the downside move or make some good capital. Now, let's say you bump the contracts up to, let's say, 5 contracts. Okay, so that means you're selling 10, protecting 5 on one side and 5 on the other. Well, now you're talking about risking about $700. Okay, and here if we, let's say, if we sell off right away, well, you make about $380. Now, this, of course, doesn't account for the volatility. If then you go ahead and do a few weeks of time decay, well, then you're up about 1,130. And then again, a few weeks later, up about $3,600. But if it just stands still, well, you're risking your $750 to make about your $3,000. And really, at the peak, what you can make is about $19,000. So dropping it back down to one contract, this is really how it works on a basic butterfly spread, and how you make a low risk investment for a downside move in a butterfly. And of course, you could adjust this even further. And let's say I go to 2785, and now I'm risking only $50 for that same kind of potential. But of course, I'm risking on this side $1,545. So I wanted to share this strategy with you because this allows time decay to kind of work in your favor. And then with time, let's say you're risking $55 or $60. With time, you could see that for that $60, if you had a 100-point move, well, you're making about $1,000, right? Now, keep in mind, they'll margin you out the 1,500 because that's the most you could lose in your broker account. But overall, if the stock stands still, you're out $40, which is not a lot of money. So in either case, this is a nice strategy if you're expecting a nice big downside move to hedge things without risking a lot of capital. I didn't cover the volatility side of the butterfly here. I just wanted to share with you the strategy and some of the basic setups for it. But you could see how you could really play with this to create some very interesting strategies for a downside move. So be open, play with this first. And again, don't forget to account for the volatility because you have to take those things into account when trading options. In either case, thank you so much for joining me in this week's video. Just want to share this option strategy with you. I hope you find it helpful. Maybe we'll do more of these option strategies, variations, and setups to give you some ideas of what you could do with options and how to create them, how to concoction them, and maybe later we'll get more into adjustments. But in either case, thank you so much for joining me. Don't forget to sign up to the newsletter list by clicking the button right over here, or check out my Getting Started page, subscribe to the channel, and see some of the other videos. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. And if you're on the newsletter list, we also have a new course that's coming out next week, Passive Dividend Investing. So check that out as well. Anyways, I'll see you next